Welcome to Stress-Free Investing Analysis, Personal Notes.
I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. All right, with that out of the way, let's dive right in. Today, we are undertaking a forensic, completely stress-free explainer of Astral Ltd's business fundamentals. This company has been an absolute legendary wealth creator in the Indian market, but we really need to look under the hood to see if that thesis still holds up today.
Here is our roadmap for today. First, welcome to Stress-Free Investing. Second, unpacking Astral's brand moat. Third, financials and the capex cycle. Fourth, the cleanliness stress test. And finally, valuation and final verdict. Let's get to it.
Section 1. Welcome to Stress-Free Investing, the forensic deep dive.
Let's start by tracing the evolution of this incredible building materials giant. Astral was incorporated way back in 1996, but their real masterstroke? That happened in 1998 when they pioneered CPVC pipes in India under a license from B.F. Goodrich, a company you probably know today as Lubrizol. That first mover advantage was huge. It literally set the stage for everything that followed. Fast forward to today, and they are executing some absolutely massive capacity expansions. For instance, they've got the phased commissioning of their Kanpur plant lined up for FY26. But you know what the real game changer on the horizon is? It's FY27. That's when their next-aligned chem backward integration kicks in. We are talking about a 150 crore rupee project that brings CPVC resin manufacturing completely in-house. That is going to significantly deepen their moat and give them incredible control over their costs.
Section 2. Unpacking Astral's brand moat, beyond just pipes.
To really understand their premium valuation, we have to unpack this moat. Just look at this breakdown. Despite aggressively diversifying into new categories like paints and adhesives over the last few years, a massive 72% of their revenue still comes from their highly profitable core plumbing segment, and it is highly profitable. The plumbing segment commands impressive EBITDA margins, right around 16 to 18%. Meanwhile, the paints and adhesive side, which makes up that remaining 28%, is currently operating at slightly lower margins of 12 to 14% as they scale it up. So make no mistake, the core investment thesis here is still absolutely all about their dominance in plumbing.
And that genuine first-mover advantage we just talked about, it creates a fortress-like moat. It gives them pricing power that your everyday commodity PVC makers just can't match. You see, CPVC isn't your standard plastic. It requires strict technical certifications like NSF and BIS approvals. Plus, Astral has spent decades, literally decades, building immense plumber loyalty through specialized training programs. They distribute all this through a sprawling network of over 200,000 retail touchpoints. Just think about that scale. It means an end consumer or contractor is highly unlikely to switch brands just to save a few pennies.
Section 3. Financials and the capex cycle, the numbers game.
Let's talk numbers, because they are undeniably impressive. Astral has been a spectacular long-term compounder. We're talking about delivering 15% annual revenue growth over the last 10 years, consistently. They have successfully and consistently outgrown the broader plastic pipes industry.
But here's what's even more impressive. Their profit after tax, that has grown at a 21% compound annual growth rate over that exact same decade. What does that tell us? It proves their revenue growth wasn't just empty volume. It translated directly to the bottom line, all thanks to that incredible pricing power and operational leverage we just unpacked.
But wait, here is the central mystery of our analysis today. Take a look at their free cash flow. It has recently collapsed. In FY21, they generated a massive 493 crore in free cash flow. Fast forward to FY23, it was down to 247 crore. And in FY25, it dropped all the way down to just 90 crore. That leaves them with a microscopic free cash flow yield of roughly 0.2%. I mean, if you just looked at this chart in isolation, you might panic, right? Well, hold on. The crucial point here is that this cash drop represents a deliberate, temporary capex cycle. It is not a structural decline in the underlying business. Astral has been heavily reinvesting its operating cash flow into massive new physical plants in Hyderabad, Kanpur, and Dahej. Naturally, when you build out massive factories, this heavy investment phase temporarily compresses your return on capital employed, pushing it down to around 20%. But here's the light at the end of the tunnel. As these major plants become operational and utilization ramps up, we expect to see a strong recovery. We're looking at normalized margins and cash flows returning by FY27.
Section 4. The Cleanliness Stress Test, Forensic Accounting.
Before we even think about price, we must run a stress test to ensure this is truly a safe, stress-free investment. And these quantitative models, they prove Astral is fundamentally immaculate. The Piotrowski F-score sits at a solid 7 out of 9, showing really strong underlying profitability and operational efficiency. Then you look at their Altman Z-score, it's a staggering 35.5. Remember, anything above 2.6 is the safe zone. So a 35.5 means they have essentially zero distress or bankruptcy risk. And finally, the Benish M-score is -3.6. That is well below the threshold, indicating highly reliable, clean cash earnings. There are absolutely no signs of earnings manipulation here.
Now, what's really fascinating on this slide is how their near-zero debt profile provides incredible safety, especially while they're building out all those massive new production capacities we talked about. There is zero promoter pledging. The founder family maintains a rock-solid 54% holding. Talk about serious skin in the game. Crucially, their operating cash flow to profit ratio is greater than 1 across all years. That means their reported profits are entirely backed by cold, hard cash. Add in a phenomenal 17 times interest coverage and a microscopic debt-to-equity ratio of just 0.06x, you've got a balance sheet that is built like an absolute fortress.
Section 5. Valuation and final verdict. The ultimate question.
Finally, let's tackle the most highly debated part of the Astral thesis, the valuation. Is an 81.9x PE ratio justified? Look, trading at nearly 82 times trailing earnings, Astral is undeniably expensive. They are priced for absolute perfection. That means management has essentially zero room for execution errors. To put this into context, peers like Supreme Industries trade around 45 times earnings. Astral commands this massive premium because of that CPVC brand moat we discussed, but at an 82x multiple, you have to remember that a lot of future growth is already heavily priced in.
So we have to carefully weigh both scenarios. In the bull case, Astral benefits from potential anti-dumping duties on cheap PVC imports. They sustain the massive 20% volume growth we recently saw in Q2, and they get a major margin uplift from that Nexalon backward integration. But the bear case is very real too. They could face persistent losses as they try to break into the highly competitive paint segment. They are currently suffering from a negative return on incremental invested capital over the last 3 years, and of course, any sudden global polymer price spikes could instantly compress their margins. Taking all of this into account, we're landing on a base target of 1,680 rupees. The verdict? It's a hold, or an accumulate if the price dips below the 1,400 rupee level. At current prices, the risk-to-reward ratio is just slightly unfavorable for new money, offering only about 7% upside to our base target. But hey, if you get a chance to accumulate below 1,400, that builds in a much, much better margin of safety for this phenomenal compounder.
Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a CB-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a CB-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update.
I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next video. Thank you for watching, and keep your investing stress-free investing.